Welcome back, everyone. On this episode of the Joseph Carlson Show, we're going to be doing a portfolio review. I'll be going over all 8 holdings in my portfolio and why I own them. And if you're not aware, we have a competition going on. Me against the S&P 500. More specifically, the Story Fund. This portfolio against the S&P 500. I've started this in early 2021. That wasn't the optimal time to start a tech portfolio. It since has had all of its companies. All the holdings here have been re-rated downwards. Multiples have compressed, and I'm currently in the red by $38,000. When I look at this in terms of invested capital, I'm down around 25%. So we're not off to a good start. We're getting beat by the S&P 500, but I still fully believe that I can close the gap between this portfolio and the S&P 500 and surpass it from now till the end of 2025. Now, the Story Fund, since the beginning of 2021, has underperformed the S&P 500. It's done terrible at some points. So if I actually mark this up, right here is when Netflix had its dramatic sell-off, as well as Alibaba went down. That was a bad month. My portfolio just plummeted. So I took a bit of a hit there. And basically, ever since then, what I've been trying to do is just recover from that hit. So this whole time period, this has been a time of recovery, trying to refine the strategy. I thought Netflix was a little bit oversold, so I bought more of the company as it traded down. We've had some companies do really well. One of the companies that have helped my portfolio go up a lot over the past month was Crocs. I bought the shoe company Crocs. I thought it was deeply undervalued. The company went up 40% in less than 2 months, and I sold out at a 40% gain. So you see a pretty big spike there. Some of that is Crocs, and some of that is just the portfolio itself has done really well over the past month. If we look at the past 30 days, it's up 10%, while the S&P 500 is up 2.5%. So it's doing really well recently. Some of this is from Netflix. Some of it is from the Crocs sale. Some of it is from a lot of these companies that I think have been a little bit oversold, now starting to have a little bit of a reprisal. So overall, we're tracking this. I'm going to continue to track it. Whether I win or lose, you'll see. I'll admit defeat if the Story Fund loses to the S&P 500 by the end of 2025. But either way, you'll get a front row seat to this. And that is the goal here, to have a better return than the S&P 500 over a 5-year period. Now let's go ahead and dive into the portfolio. The first one we'll start off with is my top holding, which is Amazon. The reason that I've invested so much into Amazon, $54,000, is because of how confident I am in this company in terms of its downside risk and its future potential. I think Amazon offers a mixture of, I think, a good floor in its valuation, and I think it has a lot of upside. Having said that, it's sold off like crazy this year with the rest of the tech companies. So Amazon is going through a huge investment cycle. It's gone through a lot of trouble, and I've continued to add to the position aggressively all throughout this year, bumping it up from a $20,000 position to a $30,000 to a $40,000 to a $50,000 position. I've continued to just add more and more to it. Now, why am I adding so much money to Amazon? Why do I feel so strongly about this company? Well, if I look at it just in terms of valuation, let's just talk about Amazon's valuation. It has roughly right now a $1 trillion market cap, just below 1 trillion. And the company has a lot of different businesses. But if we focus on just 2 of them, it has AWS, which is Amazon's web services, and it has the ads business, which is tied to its marketplace. The ads business alone did $10 billion in revenue last quarter. So the ads business alone, I think, can do at least at a minimum $40 billion in 2023. That assumes zero growth in ads, and it's been growing at 25%. So these are very conservative assumptions. $40 billion from the ads business, and then you have AWS. This did $20 billion last quarter, and it's growing at around 20 to 25%. And again, I'll just assume that it stays flat, no growth. It does $80 billion in 2023. So between these 2 revenue lines of just the ads and just the AWS, and ignoring every other aspect of the business, we have $120 billion in revenue. If I attach 30% margins to that, which I think is reasonable, the ads business is very high margin, it's very targeted, and AWS has had anywhere from 28% to 35% margins. So if we average that out and attach 30% margins, that's $36 billion in profit just from those 2 businesses. So we have a company that has $36 billion in profit with a $1 trillion market cap. That would make it, based on this year's math, trade at a 3.6% free cash flow yield. And that to me doesn't seem too expensive. An almost 4% free cash flow yield for a company like Amazon. And that's not even counting any other aspect of the business. Now, Amazon right now has a lot of expenses. They've been firing people, laying off people. They overbuilt their fulfillment network. They're trying to size it down. They're actually closing some leases. They're firing people from their headquarters, and they're probably having a lot of churn and reduction in employee count in their fulfillment centers. So I also expect, while they're growing this profit stream, that their expenses come down. And I think the combination of lowered expenses and rising profits makes this company a very compelling investment. So that's my very brief analysis of Amazon. I think the company's great value, even based off of this year's math. You don't even have to go out multiple years to believe this company's good value. Now, moving on, we have my next largest holding, which is Netflix. This one has been a challenging holding over the past year. Streaming as a whole has been slaughtered. Not just Netflix. Netflix had a challenging 2022, but Disney did as well, Paramount did as well, Warner Brothers, Discovery did as well. Every streaming company had a very difficult time in 2022. You can look at the stock chart for any of them. Netflix fell from its high to low by 70%. It went down 70% in price, and somehow I'm down 24% on this holding. Now, how did this happen? How am I only down 24% when the company went down 70? This is why I'm only down 24%. I've continued to buy the company even after it sold off, even after Bill Ackman was selling out of it. I've continued to add to this position. Now, rather than just give my opinion on why I'm still invested in Netflix, I'd rather get someone else's opinion that I agree with. This is Tom Rogers. He went on to CNBC this morning and explained 5 different reasons of why he thinks Netflix is going to be a massive winner in the future.
Why Netflix is in a league of its own, which I've been saying for a long time, and well on its way to becoming the most valuable media company in the world. First, most importantly, as they pointed out, they're not anchored down by legacy media issues, which are really confounding all the other major media companies. Similarly, they're not burdened by debt. The other media companies are increasingly feeling that issue. They have the lowest debt to EBITDA ratio in the media world, a little over 1 times. 3, they've been fighting this bear thesis for a long time that they'll never be cash flow positive. They're now showing with $1.6 billion in free cash flow in the quarter. This year, going to $3 billion next year. They are well on their way to being a real free cash flow conversion machine. 4, as they pointed out, the vast majority of television around the globe is going to be streaming. And they are the leaders in streaming. Only 40% of viewing today in the developed countries, including the United States, is streaming, 10% or less in many other countries. They have so much opportunity still as the leader in streaming as all television becomes streaming television. And finally, this plan to take these 100 million users who are not subscribers, who have been taking the service for free, and finally having a basis to convert those to paying subscribers. It's going to reaccelerate, I think, sub growth, certainly going to reaccelerate revenue growth. Having an ad tier was the first step toward that, and they're well on their way, I think, to being able to solve an issue they should have attacked a long time ago.
So that's Tom Rogers' opinion, and I find myself agreeing with him. Now, in terms of valuation, I just want to give a couple quick thoughts here. Netflix does look expensive if you're looking at immediate next year valuation. So when you look at this, we have a company that is at $142 billion market cap, pushing up to $150, and it's expected this next year to have over $3 billion of free cash flow. So $3 billion in free cash flow in 2023, and the company's trading around $150 billion. So it's trading at roughly 50 times its next year's free cash flow, which is pricey. And I get that people, would be scared away of the company investing in it at that price. What I'm looking at is overall trends and growth rates of the company. When I look at this, I see a company that in 2019 had minus $3.1 billion in free cash flow. That is $3.1 billion negative free cash flow. In 4 short years, it went from $3.1 billion in the red to $1.6 billion in the green in free cash flows. And then this year, it's going to go up and it's going to double this amount of free cash flow. That's a growth rate that I like seeing. I like seeing companies that are growing free cash flow by $1 billion per year that are at a $150 billion market cap. And keep in mind that while Netflix is growing their free cash flow at this rapid speed, the S&P 500 is not. The economy is slowing down. Last year, the S&P 500 free cash flow went negative. It actually went down. So Netflix is increasing its free cash flow year over year at a rapid pace while the rest of the market isn't. And I think this is going to continue. I think the business has a lot of operating leverage. We can already see that with its expenses. Sales and marketing have been flat for the past 5 years, while the company's revenue has literally doubled. That's showing a lot of operating leverage. So when I look at Netflix, it's more of a multi-year valuation. I think the company is valued fairly based off of this next year, but I think over the next 3 or 4 years, it's going to surprise to the upside. That's my opinion, but invest at your own risk. Now, next up, we have my third largest holding, which is Google, and I'm still even in the red on Google. It's been nearly impossible to pick holdings in a tech portfolio that have done well over the past year and a half. 2022 just did a number on all of these companies. Regardless, Google isn't too bad. I'm down 15.8%. I think I can recover from that. It's only a matter of time. I have $18,000 in total cost basis on the company. Now, Google, in my opinion, was facing one key problem to the story, one big threat to the story, and that is a bloated cost structure, overpaying employees, hiring too many employees, too many pet projects, too many things like other bets where they just burn money. Overall, the cost structure of the company. Google has an incredibly efficient core business, which is their search business. But then they have all of this ancillary stuff, all these different things they're doing that they spend a fortune on. They spend a fortune funding it. They spend a fortune on stock-based compensation. And that's kind of been the balance of it. So Google has had a good side, their core business. Then they've had this bad side of a story, which is all of their expenses. And Google's actively working to solve that problem. They're solving the bear thesis. And unfortunately, part of solving this issue is cutting down on staff, which is something that's never fun to do. And although I don't like seeing people get fired, and I think in the case of Google employees, I think they're going to be fine. The market is hungry for these skilled employees. So I think they'll be fine. But even though this is sad news, it is good news in terms of the investment. In terms of investors, this is something they are wanting to see. In fact, the reason that Google's up 4.5% today is because of the job elimination news, getting rid of 12,000 employees. And that's sad again, but it shows that the company is now paying closer attention to its cost structure. So all of these big tech companies that recently have been announcing layoffs and they're focusing on cost structure, that makes them more attractive investments to investors. And outside of the inefficient use of free cash flow, which they're addressing now, the company does look like it's good value. 17 PE ratio, above 4% free cash flow yield. Now, after Google, we have another big tech company, which is Microsoft. I have roughly $14,000 invested into this company. I'm down just over 10%, which is not too bad, all things considered, when I was buying this company. So I'm down a little bit, and I think I'll make my money back with this company as well. When I look at Microsoft, the investment thesis is very simple. I view the company somewhat like a bond. It's like a treasury bond because Microsoft is going to be able to pay back its debt just fine. It has a credit rating that's better than the US government. So when I'm looking at it, I compare the yield right here, the free cash flow yield, and I compare it against the 10-year treasury. This is your alternative investment. You can invest in the 10-year treasury and earn a 3.5% yield right now. That's pretty high. That makes Microsoft have competition. You can either buy the treasury or you can buy Microsoft. You can also buy the S&P 500, which has a 3.4% free cash flow yield. So Microsoft has a similar starting yield to both the 10-year treasury and the S&P 500. The reason that I choose Microsoft over those other two opportunities is because the company, I think, is highly entrenched. I think the cloud Azure business is going to continue to propel free cash flow per share growth. And I think the free cash flow per share growth will be anywhere from 8 to 15% over the next decade. So I'm looking at this long term. I think the company is very attractively valued right now compared against the S&P 500 or the 10-year treasury. Now, after Microsoft, we have Adobe, which right now I currently think is the most undervalued company in my portfolio. I think that this is it. Adobe's the best value in terms of risk and reward. Let me go over why I think that. Adobe's a company that I think has an incredibly good moat. People talk about other different creative software, but I see Adobe as heavily entrenched, similar to Microsoft. And this company really just purchased the one rising threat to its business and something that gets its foot in the door in an entire different part of the company, which is collaborative design, and that's Figma. So they basically bought out a threat as well as a new growth path. I think that was overall beneficial for the business. But regardless, looking at this business, I see it as having a high starting yield. The free cash flow yield is 4.5%. And unlike a lot of other companies, this one doesn't dilute like crazy. It has some stock-based compensation, but the free cash flow far exceeds it. So right now, Adobe sits as a highly entrenched business, a wide moat business that has a current free cash flow yield above 4.5%, higher than both the 10-year Treasury and the S&P 500, while the company, in my estimates, can grow its free cash flow per share at well above 10%. I think Adobe could actually grow its free cash flow per share. I think it could compound that at a mid-teens rate, 15% over the next decade. In the past decade, it did it at 20%. So I'm assuming deceleration. I'm assuming things slow down. Even with the slowdown, I believe the company is heavily undervalued. On top of that, Adobe is a capital-light, flexible business that I think the downside risk is very minimal. Now, next up, we have Salesforce. This is a company that I've actually been more discouraged over the past year than any other holding in my portfolio. Salesforce just seems to have endless amounts of trouble and struggle and problems internally with the company. The latest one is the Slack acquisition. They paid a fortune for Slack. They tried to integrate it with the company. I thought that Slack was a good asset, but then we're hearing that the companies are not getting along. Leadership of Slack is leaving. We have the co-CEO leaving. We have an executive exodus happening. And it's just bad news, not things that I like to see with companies that I'm invested in. For that reason, I've tried to control risk in my portfolio by not adding to this position. I really have not added to it recently or any time over the recent past. Instead, I've been adding to Adobe, I've been adding to Netflix, I've been adding to Amazon, companies that I like the fundamental developments of. But Salesforce continues to have problems. And out of all the things that are actually discouraging in Salesforce, I think one chart shows it more than any. This is the problem that I just keep looking at with Salesforce. The free cash flow of the company compared against their employee expense. It literally eats up 50% of the free cash flow. It's just astronomical, and it's a growing problem. It's like the company does not pay attention to its employee expense at all. Now, if we flip over to quarterly, it does look like it's at least getting a little bit better. The stock-based compensation isn't racing ahead every single quarter. It's starting to level out, but that's still a big concern. I hate it when companies that I'm invested in seem to be just pouring more money into these expenses and they're not running efficiently. And I don't see Salesforce as a company that's running highly efficiently, not anywhere close to Adobe. And then on top of that, there's other things that I'm paying attention to more with my companies. One of them is the budget of sales and marketing proportionate to the revenue of the company. Salesforce revenued $7.8 billion last quarter. And last quarter, they did $3.3 billion in sales and marketing. So they're roughly spending 40% of their total revenue on sales and marketing. Not a lot of organic growth. The company basically has to muscle growth through aggressive sales and marketing. So even though Salesforce, it's a pretty powerful company, I think it's highly entrenched. I think it's similar to Microsoft in some aspects. The big problem I have with this one is their cost structure and their inorganic growth. I think the company has two big problems to fix, and until that happens, I'm not adding more to the position. So over time, Salesforce has been minimized as a smaller and smaller position. Now, after Salesforce, we have two companies that are much smaller positions, Berkshire Hathaway and Apple, which combined make up $4,000. So a very small portion of the portfolio. What I'll say is that I've been using Berkshire Hathaway as sort of a place to tuck away cash. I just view it as an ultra durable, reliable business with extremely limited downside. So anytime I have extra cash, I'll throw it in Berkshire Hathaway. I think the company's undervalued. I think it will outperform the S&P 500 over the next 5 years. So I view it from that perspective. But I also feel like there's other bigger opportunities. So I'm not going to have the majority of my money in Berkshire Hathaway. With Apple, the story of Apple is basically the same as the rest of big tech. The core business model is incredible. I view Apple as more of a consumer staple with incredible economics. And the company right now is not trading, I think, at the most crazy price. Looking at this compared to other companies, I think it's very reasonable. The free cash flow yield is above 5%. And Apple may not have perfect cost structure, but in terms of big tech, I think it's pretty good. I don't see Apple doing a ton of wasteful spending that some other big tech companies are doing. So I'm looking at Apple. I look at the amount of free cash flow it's generating. The amount of actual employee expense it has is very low proportionate to it. And that means that they can just funnel money into buybacks, tons and tons of buybacks. The company bought back 2.7% of its shares outstanding over the past year. Over the past 3 years, it's averaged 3%. And that really does add up over time. Eliminating these shares outstanding increases my equity stake. And again, that really starts to add up. When a company eliminates 4.8% of its shares outstanding every year for 10 years, it makes investors in that company own so much more of it. So if the stock price dropped, I view Apple as a defensive company that can simply scoop in and buy up those shares at cheaper prices. That again acts as a defense mechanism. It boosts the stock price back up. Apple right now has remained a very small holding in this portfolio. I like these options up here a little bit better. So that's the portfolio overall, and I'll continue to give updates on the story fund against the S&P 500. That's all for now. Hope you enjoyed. See you in the next one.